Welcome back to my channel. Today in this video, we've got a major financial update you need to hear. HMRC issues urgent warning to UK households. Could you be hit with a surprise tax bill just for having £12,000 in the bank? Don't risk being caught off guard. Before we dive into the full story, make sure you hit that subscribe button right now and turn on notifications so you never miss critical updates that could directly impact your finances, your family, and your future. Let's break this down step by step, because what's happening now with HMRC and UK taxpayers is more than just fine print. It could mean thousands of pounds lost if you're not paying close attention. Millions of households across the UK may be sleepwalking into unexpected tax bills, especially those who have diligently saved money and now have balances around or above £12,000 sitting in their bank accounts. A new HMRC crackdown on interest earnings means that even modest savers, those who've simply been trying to be financially responsible, could receive unwelcome letters from the taxman. The focus? Untaxed savings interest, especially for those not using tax-free savings accounts like ISAs. And with interest rates still at some of the most competitive levels we've seen in recent years, many unsuspecting savers are crossing thresholds without even realizing it. So, what's going on here? Well, it all boils down to the government's decision to freeze certain tax thresholds while inflation and interest earnings have surged. Normally, when your savings generate interest, you're allowed to earn a bit of that interest without paying tax on it. But for higher rate taxpayers, that tax-free amount is just £500 per year. For those earning at the additional rate, which kicks in above £125,140 in income, there's no tax-free allowance at all for interest income. That means if you've got, say, £12,000 earning just over 4% interest in a standard, non-ISA account, you could be over the limit and liable for tax you weren't expecting. Sally Conway, a savings expert at Shawbrook Bank, has sounded the alarm. Without careful consideration, savers could face a shock tax bill on their nest eggs. She adds that the number of at-risk savings accounts has ballooned by over 5 million in just a few years, a sign that many Brits are unknowingly falling into this trap. Why? Because while interest rates have risen, the thresholds for how much you can earn tax-free have not. The personal savings allowance, introduced to ease the burden on savers, hasn't budged. So more interest, same threshold, equals more taxable income. Now, let's break this down with a real-world example. If you're a higher rate taxpayer, meaning you earn between £50,270 and £125,140 and you have £12,000 saved in a standard account earning around 4.30%, you're generating over £500 in interest annually. That's more than your tax-free limit. The excess? Taxed at 40%. And if you're in the additional rate band, every single pound of that interest is taxable at a whopping 45%. And it doesn't stop there. The way the personal allowance phases out once you earn over £100,000 makes the effective tax rate even worse in some cases. So, what can you do to protect yourself from this creeping tax burden? The number one tip from financial experts is to utilize your ISA allowance. Each UK adult can save up to £20,000 per year in an individual savings account completely tax-free. That includes both cash ISAs and stocks and shares ISAs. And yet, millions of savers aren't taking advantage of it. Maybe they assume it's not worth the effort, or they're just unaware of how much they're actually earning in interest now that rates are higher. Another smart move? Look beyond the high street. Specialist savings providers and digital banks often offer more competitive rates than the big names you see every day. These lesser-known institutions are fully regulated and often offer better returns, helping your money grow faster within those same tax thresholds. As Conway notes, specialist savings banks can be savers' best-kept secret. Now, let's take a step back and understand how we got here. The personal allowance, the amount of income you can earn tax-free, has been frozen at £12,570 since 2022 and is set to stay that way until at least 2028. That's 6 years of stagnant thresholds while inflation eats away at the real value of your money. Meanwhile, earnings have risen for many people, especially with recent wage inflation, pushing them into higher tax brackets even if their standard of living hasn't improved much. Here's a quick recap of the income tax bands in the UK for the 2025-26 tax year. The first £12,570 of your income is tax-free, thanks to the personal allowance. The next £37,700 is taxed at 20%, bringing you up to the higher rate threshold of £50,270. Income between that and £125,140 is taxed at 40%, and anything above that is taxed at 45%. But once your total income hits £100,000, the personal allowance starts getting clawed back, meaning you're effectively paying an even higher marginal rate in that income range. So, you may be wondering, how does this connect to my savings again? It's because the government calculates interest on savings as part of your total income. So, if you're already near the thresholds, your savings could tip you over into a new tax band or eliminate your personal allowance altogether. That means even a bit of passive income from your bank account could create a significant tax liability. And that's exactly what HMRC is starting to target with this new wave of tax letters and investigations. The problem isn't just limited to wealthier households either. Many middle-income earners are now finding themselves unexpectedly in higher tax bands because of the frozen thresholds and rising wages. Combine that with interest from savings and you've got a tax trap that's affecting millions, especially those who've been saving for years and haven't moved their money into more tax-efficient vehicles. It's also worth mentioning that the government benefits from this setup. By freezing tax thresholds while letting inflation and interest rates rise, they can quietly increase tax revenue without ever announcing a tax hike. It's what economists call fiscal drag. You're dragged into higher tax brackets over time even if your real income hasn't improved. For savers, it's a double blow. Your money loses value due to inflation, and you get taxed more on the little gains you do make. To avoid falling victim to this stealth tax hike, you need to act now. First, assess how much interest your savings are earning. Check your bank statements, use online calculators, or speak with your provider. If you're getting close to or over your personal savings allowance, move that money into an ISA as soon as possible. Second, if you're a higher rate or additional rate taxpayer, your allowance is even smaller or non-existent. You have even more reason to make your savings tax efficient. And remember, it's not just cash ISAs. Stocks and shares ISAs allow you to invest tax-free as well. Though they come with risk, they also offer the potential for greater long-term growth, especially when inflation is high. It's all about finding the right balance for your goals and risk tolerance. But whatever you do, don't leave large sums sitting in taxable accounts without a strategy. It's a mistake that could cost you dearly. So let this be your financial wake-up call. HMRC is cracking down. The tax rules haven't changed, but your interest earnings have. If you're not proactive, you could end up facing a surprise tax bill, or worse, penalties for unpaid tax you didn't even realize you owed. And if your income is rising or close to key thresholds, you may already be at risk. There's no excuse to be uninformed when the information is right here. Before we wrap up, take a moment to share this video with friends or family members who might also have money sitting in savings accounts. They might not know they're at risk either. And if you've learned something valuable here today, make sure to like the video and subscribe to my channel for more breaking news, financial tips, and updates that matter. Your money deserves to be protected, and I'll be here to help you stay ahead of the curve. Thanks for watching, and don't forget to subscribe now for more straight-talking finance updates delivered directly to you.